In the realm of the stock market, few tales are as dramatic as the recent surge in GameStop's stock price. GameStop, once a darling of the retail video game industry, found itself riding the high-speed roller coaster of meme stock mania. But what exactly are meme stocks? They're shares of companies that gain popularity through social media hype, rather than traditional business fundamentals. GameStop's journey through this volatile landscape has been nothing short of a spectacle. Recently, a surprising 17% increase in GameStop stock was observed following some rather savvy comments from Federal Reserve Chairman Jerome Powell. Amid speculation, Powell hinted at potential interest rate cuts, which often encourage investors to take on riskier assets. GameStop, positioned at the high-risk end of the spectrum, saw a significant uptick as a result. This surge is a reminder of the unpredictable nature of meme stocks, where investor sentiment can often overshadow fundamental valuations. GameStop sits precariously at the peak of the risk curve, making its recent price surge a spectacle of high stakes. Rewind a few years, and GameStop was at the center of a meme stock frenzy. Today, the reality is starkly different. In the aftermath of the meme stock explosion, GameStop has faced a steep downhill journey. The fourth quarter of 2023 painted a grim picture of the company's financial health. GameStop's shares tumbled by 18% following the release of these results, a clear indicator of the challenges it continues to face in a rapidly evolving retail landscape. During this quarter, the company reported earnings of only 22 cents per share, falling short of Wall Street's expectations. This miss was significant, as analysts had pinned higher hopes on the company, expecting it to capitalize on the nostalgia and community support that had previously buoyed its stock. A critical factor in GameStop's decline has been the shift towards digital game downloads, a trend that is reshaping the entire gaming industry. As more consumers download games directly to their consoles, the need for physical stores and even physical game discs diminishes. This shift has severely impacted GameStop's hardware and software sales, with hardware and accessories sales dropping by 12% and software plummeting by 31%. The retail giant's woes are compounded by aggressive competition from other companies that have successfully transitioned to digital models. Major players like Microsoft, Sony, and Nintendo have embraced this digital shift, further marginalizing traditional retail outlets like GameStop. This decline in sales is not just a reflection of changing consumer preferences, but also highlights GameStop's struggle to pivot effectively to an online model. The company's efforts to revamp its online presence have not been enough to offset the steep decline in physical store sales. With a significant downturn in sales, GameStop's struggle to adapt to an increasingly digital market becomes evident. The once celebrated meme stock now faces the stark reality of an industry that has moved on without it, leaving it scrambling to find its place in the new digital era. This stark contrast from its days of stock market glory underlines the volatile nature of meme stocks and the rapid pace of change in the gaming industry. In a bid to navigate through turbulent financial waters, GameStop initiated several cost-cutting measures. As the final quarter of 2023 unfolded, the company found itself grappling with a significant downturn in revenue, dropping from $2.2 billion to $1.7 billion. This substantial decrease compelled GameStop to reevaluate its operational expenses and workforce. The layoffs were perhaps the most poignant indicator of GameStop's struggles. While reducing the number of employees can lead to immediate financial relief, it also poses substantial risks. With fewer hands on deck, the remaining staff faces increased pressures, and the company risks a decline in service quality and operational efficiency. Furthermore, GameStop's decision to cut costs wasn't just about reducing headcount. It extended to scaling back on inventory and minimizing other operational costs. These measures were taken in a landscape where digital downloads are increasingly overshadowing physical game sales, a shift that has notably impacted GameStop's bottom line. The challenge here lies in the delicate balance between reducing costs and maintaining the ability to innovate and grow. Reduced investment in key areas such as customer service and product diversification could hamper GameStop's ability to adapt to new market realities. This is particularly critical in an industry that is rapidly shifting towards digital and cloud-based solutions. While necessary, these cost reductions raise questions about GameStop's ability to innovate and compete in a rapidly evolving industry. The video game industry does not pause for anyone, and GameStop's competitors are moving fast. In a world increasingly dominated by digital downloads, Companies like Microsoft, Sony, and Nintendo have been quick to adapt, leaving traditional retail models, like that of GameStop, struggling to keep pace. Microsoft and Sony, two titans of the industry, have aggressively expanded their digital ecosystems. The Xbox Game Pass and PlayStation Now services offer vast libraries of games available for instant download, appealing to a generation that values immediacy and convenience. This shift has not only increased their user engagement, but also allowed them to sidestep the physical limitations of retail space and inventory management. Nintendo, while initially slower to embrace full digital distribution, has made significant strides with the launch of its online store and expansion of digital offerings on the Nintendo Switch. The convenience of downloading a game directly to a console is a powerful draw for consumers, particularly when it eliminates the need to swap cartridges or discs. Leadership can often be the linchpin in a company's turnaround story. At GameStop, CEO Ryan Cohen has a vision. Ryan Cohen, stepping into the role with a background rich in e-commerce from his days at Chewy, envisions a GameStop that leans heavily into the digital age. His strategy? To pivot part of the company's focus towards cryptocurrencies and blockchain-related stocks. This move, while bold, aligns with Cohen's history of embracing tech-driven solutions. But the question on many minds is this the right move for GameStop? The allure of blockchain is undeniable. It promises transparency, security, and a level of engagement that traditional retail models can struggle to match. By venturing into this space, GameStop could potentially tap into new revenue streams and rejuvenate its brand, aligning itself with the tech-forward preferences of its core demographic. However, this shift is not without its perils. Cryptocurrencies and blockchain technologies are notoriously volatile and fraught with regulatory scrutiny. For a company like GameStop, already reeling from significant financial losses and a declining market position, this move could be perceived as a high-stakes gamble. Furthermore, the success of such a transformation largely depends on market reception and the ability to effectively integrate these technologies into GameStop's existing operations. The integration process itself could divert focus and resources from other critical areas of the business. Investor confidence may waver as GameStop ventures into the highly speculative and volatile realm of cryptocurrency. As we've journeyed through the highs and lows of GameStop's recent history, one thing remains clear: uncertainty prevails. In the wake of a digital revolution, this stalwart of the retail gaming industry finds itself at a precarious juncture. The shift from physical to digital media has not only reshaped consumer behavior, but has also severely undercut GameStop's traditional revenue streams. The narrative of GameStop's struggle is deeply entwined with the broader industry's pivot towards digital downloads and streaming services. Giants like Microsoft, Sony, and Nintendo have embraced this new era, leaving GameStop grappling with a dwindling market share. The stark 50% drop in software sales is a telling sign of the changing tides. Financially, the picture remains grim. The recent quarters have seen a significant decline in revenue, with the last quarter of 2023 alone witnessing a downturn from $2.2 billion to $1.7 billion. This decline is a direct reflection of reduced foot traffic and sales, a trend exacerbated by the growing preference for online game purchases. On the strategic front, GameStop has made some decisive moves under the leadership of Ryan Cohen. The focus has shifted towards cost-cutting measures and exploring new avenues like cryptocurrency and blockchain-related stocks. However, these decisions come with their own set of risks, and have not yet proven to be the lifeline the company desperately needs. The speculative nature of GameStop's stock adds another layer of complexity. Once a darling of the meme stock phenomenon, its stock price has seen volatile swings based largely on market sentiment rather than solid financial fundamentals. This makes GameStop a high-risk investment, dependent more on speculative trading than on traditional investment logic. Investors looking at GameStop are faced with a conundrum. The company's future is not just about navigating a market transition, but also about overcoming substantial internal and external challenges. With a business model in flux and an industry that is rapidly evolving, the path forward is fraught with uncertainty. While GameStop's future hangs in the balance, one must ponder: is this a sinking ship or a phoenix poised to rise? For investors, the answer lies in their appetite for risk.